What is going on, investors? It is Sunday here on the Investor Channel. This is Q&A a day number 6. This might get posted on Monday. We'll see what happens. But on the Q&A channel, leave me a comment down below with a question that you might have, and I'll get to it as quickly as I possibly can. I also have down in the description and the first pinned comment timestamps to all the questions on today's episodes. So if you want to jump around and find the questions that you want to watch, that is available for you. Let's jump right into it. First question, it says, hey, thanks. I see a lot of videos saying that the stock market will crash and it won't recover. Are they lying? Sure, I can see a pullback or trade sideways, but can they really say the stock market will crash and take years to recover? I don't believe them. So coming over to YouTube, you search stock market crash and you see, the usual suspects here popping up on the feed. Some of these guys have big subscriber base. Some of these people might not, but one thing I'll show you here is if you type in stock market into the search bar, look at what starts coming up. Look, crash. So savvy YouTubers are seeing this. They're seeing there's a lot of search volume, so they make a video and they get a fair amount of this video by Meet Kevin has 262,000 views. That is what a lot of YouTubers are striving for. And look, every creator is guilty of it, making a video that they know gets a lot of search traffic or that they know a lot of people will watch. And nobody wants to make a video and have nobody watch. And so part of YouTube and really CNBC as well, this goes for any financial media, I would look at it as about 90% of it is entertainment. Okay, even these YouTube videos, they might be right. Look, these people might be right. A stock market crash may be coming. Maybe it will take years to recover. Honestly, I don't think if anybody out there was smart enough to accurately predict that, they'd be richer than Jeff Bezos. They'd be one of the top 4 or 5 richest people in the world. If you knew exactly when a stock market was about to correct, you could get out. When it bottomed, you come back in. Just keep in mind that a lot of this stuff on YouTube is entertainment. And look, entertainment can be educational at the same time. It can give you some educational value. But what I want you to realize is here's about a 20-year chart of the SPY, which is an ETF out there that tracks the S&P 500. And basically, as we've seen here, what I've done is I've drawn in trend lines on any kind of pullback or sell-off or quote-unquote crash that could potentially be factored in as a crash. And then I drew trend lines in here that are uptrends. And I think we're still in a pretty bullish uptrend here, even though we have several actions here that could be looked as kind of crash and pullbacks, but it's always pulled back up into the uptrend. You see here, it's almost an equal number of kind of pullbacks as, uptrends, but the uptrends are always seem to be lasting much longer. Here was our 2009 financial crisis. Somewhere in here is kind of the March lows that we made here because of the virus. But as you can see here, the stock market, yes, it can take a look at here. This was in 2007. We made a top. We really didn't get above that until about 2013. The people that need to be very cognizant of a stock market crash, in my opinion, are typically people close to retirement. So if you're close to retirement, you have $1 million, $2 million, $10 million, however much it is in a retirement account that you've built up over your entire lifetime, yes, you probably do want to be more cautious, because if you want to retire, if you retired in 2007 and you lost whatever this is, 40, 50% of your net worth, and you would have had to let it sit there for 4 or 5, 6, 7 years while you're in retirement trying to spend that money to get it back. This is why portfolio allocation changes the older you get. Younger people my age, 30, 40s years old, I would say in your buy and hold portfolio, I wouldn't worry too much about crashes or pullbacks. In fact, in my opinion, you probably want to actually look forward to them because they do create buying opportunities for you. Now, again, Stock markets can crash. They can take years to recover. I wouldn't necessarily worry about when it's going to occur or if it's going to occur. Again, unless you're close to retirement age or you're in a different situation. Maybe you're a younger person, but this is kind of like money that you might need, maybe for rent or to buy a car or to invest in a business. Well, then obviously you're going to be a little bit more careful with that money. Maybe set some stop losses. Okay, stop losses, stop losses, stop losses. Even in this 08-09 financial crisis, there's some big candles in here, but you had plenty of time to set a stop loss and have it hit. All these pullbacks give you time to get out. Okay, we rarely, if ever, I mean, this is a monthly view. There are some big gap down days included in here, but it does give you time to get out if you do need that money. So I wouldn't say any of these YouTube, guys and girls are doing the wrong thing. They are just playing the game here on YouTube, trying to get views, trying to make videos that are popular and get watched and get them subscribers and things of that nature. But, if any of these people knew exactly when this crash was coming, boy, they'd be multi-billionaires, maybe even close to a trillionaire. Okay, it's entertainment. Take it with a grain of salt, and I wouldn't worry about it too much, again, unless you feel like you're going to need that money in the very short term, next 3, 4, 5 years, because as you can see here, the markets tend to recover and they tend to go up over time. So hopefully that helped answer your question. It says, hey there, I've noticed that sometimes there's a huge arbitrage, like a $4 or $5 gap in some cases, between the price of the stock and the price of the warrants of SPACs, mostly after exercise them to stock. So apparently you can buy the warrants and right after ask your broker to exercise them to stocks and then sell them and benefit from the arbitrage. Would you consider that as a possible strategy? Okay, so I haven't necessarily heard of this. This is probably a strategy. It's not one that I use. The strategy that I'm probably a little bit more aware of is a company gets bought out, and typically, let's just say, for example, a company gets bought out at a $50 price tag, but the stock usually doesn't, I wouldn't say usually, but sometimes doesn't get all the way to that $50 price tag. Let's say it goes to 48, because there's breakup risk. There's other things there that could potentially keep that stock from selling for $50 to the buying company. So there's an arbitrage there. I would say that this is something that you probably could do. I don't know in this specific example you're asking. I don't know if there's extra fees on here, if every broker will allow you to do this, if there's a minimums or whatever. I would look into all of that. Here's what I will say. Is what I would do is if you want to do this, I would set up a completely different account if possible, okay? Set up a different account, put some money in it, and monitor your results with this, because what I'd want to see is, does this strategy pay off time and time again? Yes, there could be opportunities that pop up. What you could find is that over the course of a year or 2 years of 3 years of doing this, that potentially other strategies are simply better and return more on that capital. Okay, everybody has a limited amount of capital unless you're like Jeff Bezos or something. So you just want to make sure you're allocating this properly. It could be a very safe thing to do, and so you could allocate a certain amount of your portfolio to this strategy because it's a very predictable way to return money. I would let you figure that out. I would do a fair amount of research on this. You could call a broker, obviously not a Robinhood or something like that, but if you're with a Schwab or a E-Trade or something like that, you should be able to get a fairly well-educated person on the phone to help walk you through this and talk about kind of the risk and rewards of this type of thing. Again, good brokers. This is why I have the bulk of my money in a Schwab account, in E-Trade, TD Ameritrade, those types of places, because they provide much, much broader support than a lot of the apps that a lot of people are using today. Again, not saying that Robinhood or anything like that is not worthy to be used, but when you want support or have questions that are very detailed like this, I would take it to your broker and ask them, any kind of risk associated with them, and also any kind of extra maybe potential fees or anything like that. You also want to factor in taxes and all that as well. And again, I would do it in a separate account so you can kind of monitor that performance and see what happens there. So great question. Wish I could give you a little more insight. I tell you what, if this works for you and you're doing well with it, leave me a comment down below. Maybe we can get you on the channel and we can talk about it. Thanks for the question. Next question's coming in from Kenneth. He said, why would you categorize CRM, Salesforce.com, as a swing trade category instead of a buy on dip long-term investment? When you decide to swing trade a stock or to buy on the dip, what factors would you count on most? Thanks for the time and thanks for the question. So this is a good one. So what he's referring to is I had some videos on Salesforce.com where what happened is when the company announced earnings, this thing gapped down, and this is I'll probably do a video on this at some point. This is turning into one of my favorite type of formations for a kind of a swing trade or a quick trade. I'll show you the actual trade that I did with CRM. So I bought it initially at 223 down in this range, and then I bought it again. It melted down just to 221, which is right here. Almost got it right on the bottom. And then I sold it as it kind of came back up into this box up here at 228. So I made a couple bucks per share. But what I will tell you also is that I actually bought fractional shares in my son's account of Salesforce when I saw this gap. I think it did create, this is one of the rare opportunities where a stock had a gap down and I thought it made a good trade, but also a good buy on the dip kind of hold, exactly what he's talking about here. And so he asked, what factors would I count on the most? Okay, there are two different things going on here. First thing, from a trading perspective, I like this formation, okay? We had a gap down, and I wouldn't say this, it's not all the time, okay? It's not 100%. Nothing's 100%. But in my opinion, in my experience, there's often a fairly high probability when it's a company like CRM that's well-known, well-covered. We're not talking about micro-cap, penny stock type stocks here. But when you have this gap down on earnings, typically, as long as there's not anything crazy going on with the company, like management change or something like that, or sector change, well, then the stock likes to walk back up into support levels or resistance levels, whichever way you want to look at it. And that's what I figured would happen here with CRM. So from a trade perspective, I liked the setup here, okay? I liked the gap down with the high probability that it would walk back into this zone, and that's exactly how I played it. I bought it down in this range down in here with the idea that I was going to sell it up in here in this box. Now, the other edge of that sword and the other part of his question is, when do you decide to buy it on the dip as a buy the hold? Well, that will take us into a whole separate conversation where we don't really pay attention to the stock chart. It's more about the financials, the fundamentals, which I have a video I've recently posted on Salesforce.com where I talk about the financials, I talk about the revenue, we talk about those types of things. If you're comfortable with that and you're comfortable with the market that CRM is playing in and they're going to continue to dominate, I know they just agreed to buy Slack. And so those types of things will probably, in my opinion, accelerate CRM's business model going forward. So in this case, it could be an excellent kind of average in or average down, depending on where you're in on this stock. This could also create a great kind of opportunity to buy the stock as a buy and hold investment. This is one of those rare cases where the fundamentals of CRM could have made this a buy and hold, but it also, in my opinion, also set up perfectly for kind of a swing trade. And that's personally how I played it, at least how I showed here on the channel. But I also bought, again, a couple probably like $50 in my son's account for CRM. So rare case where you could have probably played this both ways, but what factors do I rely on most? On a swing trade, I'm almost 100%. I don't want to say it's 100%, but it's probably 90 to 95%. I'm just looking at the chart, okay? For a buy and hold investment, it's probably flipped the other way. I'm probably maybe 10, 15% on the chart. The price action, is this a good level to come in here and buy the shares? And the other 75 to 80%, it's all about fundamentals. It's all about where they're going. Hopefully that helped answer and clarify that question for you, Kenneth. Thank you for that. Next question says, hey there, I love your analysis of your videos. So much value in them. I just started to build a position lately on CleanSpark. It's kind of speculative as they are a 200 million market cap company, but they are already working with massive organizations like Tesla, Walmart, U.S. Marine Corps, and the U.S. government. Can you give an opinion on that company? So tell you what, he said it was a $200 million market cap. Now it's 600, so he's probably doing pretty well. This question was posted a little while ago, so he's probably riding pretty good on this one. Definitely didn't need my help on this one. I'll just show you just briefly what I do when there's companies like this that I've never heard of. There's a couple things you do. First thing, come to their investor relation page. The way you find this is type in the company name and then IR. So you do, the company name, or you could even do the ticker and then IR, which is or stands for our investor relations. Now there's these investor presentations. They just give you a little overview here. Usually what I find is the SEC filings. So I come here to SEC, see what they've been posting. That they just reposted an annual report. So this annual report's 86 pages. You don't have to read it like cover to cover like a book, but if you want to know more about it, I would definitely come in here. And this goes for any company. This is not just CleanSpark, what we're talking about. This is for any company that you want to find. Now, what I typically do with these 10Ks is I come right to the financials. They tend to be buried, okay? On a quarterly report, they're usually right at the top. On a 10K, they bury it after a lot of legal mumbo jumbo and other things out there. Again, that stuff is worth reading, but I don't waste my time reading that until I come into the financials first. If the financials look good, it looks like something that I want to invest in, then I go over to the 10K. Now, look, this guy may not have done any of this and he might have tripled his money. What I'm trying to tell you is here's a system that I use. I tend to be a little bit more conservative in what I invest in. I'm just giving you my opinion here. It may not work for you, and you may have a strategy that can develop even larger gains than what I'm showing you. I'm just showing you what I do. So I come down here to the statement of operations. That's a revenue, and then we get down to kind of a net loss or a net profit, depending on what company you're looking at. And these are as written. There's not in thousands or millions. So they went from 4.5 million up to 10 million. That's solid growth. So you can see why when you come over to the stock chart, this thing's been on a nice little ride here just over the last month or so. It's probably a little bit of, we've got some sectors that are really, really hot right now. And I would imagine this company is probably in there. I've been seeing some news here related to Bitcoin and some other stuff. I mean, Bitcoin's just been on absolute fire. And so they're kind of riding that wave. So you want to be aware of that. Now, the total cost of their revenues, this isn't necessarily a high margin business. You see, they spent about 8 million to make 10 million. So they grossed out 2 million. Again, way over, about 3 times, even more so than that, than the previous year. But, just something you want to keep in mind. Not a super high margin business from a gross perspective. And then when you take in fact, in these operating expenses, they're hefty, man. And in fact, they're flat year over year. So this is not a bad thing. Okay. We basically came in a dead flat on our operating expenses, but we more than doubled. That's a 2.5x or so on the top line. So that's good. Eventually, things should start flowing to the bottom line if they can continue this type of growth. I would do a lot of research into their revenues and if it's recurring, if it's something that will continue year after year, month after month. We see here loss from operations basically stayed a flat, year over year, leading to a net loss right around $23 million. So the company is losing money. They are in fundraising mode. Here's our cash flow statements here. We pull down that net income number. We either add back in or subtract some things. We get to negative 6.6 million cash flows. Not necessarily that important when you're in fundraising mode. See here, proceeds from issuance of common stock, 4 million. So this is going to flow to the balance sheet. And we got proceeds from promissory notes. So we see here, this company did a lot of fundraising last year as well. They raised about 14 million. This year, about 4.3. So not quite as much this year, but still, in my opinion, kind of fundraising mode because, again, they're losing money on a year-over-year basis. So Moving over the stock chart, this thing is just on an elevator shaft. And another thing that I typically don't. Now, I think this guy asked this question probably back. There's a terrible line. Sorry about that. So he asked this question several weeks ago. So I want to say this stock was down here at probably 10 or 11 bucks a share. That was the time to buy, in my opinion. Okay. This moving average was turning positive. This MACD was starting to turn. Everything was looking good. If he bought it anywhere down in here, that was a great buy. Now, I have a rule, just myself. I don't buy stocks that are on straight upwards. I don't buy them all the way down. And when I say I don't, if you want to buy, what's this, $25 a share, if you want to buy like 2 shares or something, I don't mind that. Put it on a watch list or something. You know, some people, to put a stock on their watch list, they kind of need to buy it. I totally get that. If $25, $50 is not a significant amount of money to you, buy a share or two, put it on your watch list, watch what happens. I do that from time to time. But in general, I don't like to buy stocks that have gone straight up, and I also don't like to buy stocks straight down unless it's some kind of trade or some kind of setup in that sense. So I don't necessarily see anything like that going on here. I would just be careful with this one. If you're starting a position up in this elevated range, you're going to want to do extensive research. And like I said, you're going to want to come to this 10K and look at, you don't have to read this like a book, okay? But at least scan through a fair amount of this. And then you can also come over to sites like Seeking Alpha. There's a fair amount of articles and you'll see different opinions. This guy's bullish. This guy's very bearish. These guys are neutral. These guys are bearish. I would read these, and I some of these are a little older and they might not be relevant, but I would definitely read the last 2 or 3 articles that have been published. Kind of just give you a perspective. You can also kind of roll through the news. I see a Bitcoin in almost every little bit of news here. Bitcoin is on absolute fire. Okay. I know this because I have a little bit. And so, you just want to keep that in mind too. Do you really want to buy when the fire is raging, or do you want to buy when it's cooled off a little bit and maybe have a little bit more upside potential? So, hey, look, it looks like our questioner bought this stock down in here and he's doing great. Your guess is good as mine what it will do after this, but this stock has had a solid run. The financials are, they're not great, but they are growing and they are keeping cost somewhat in check. They have plenty, I wouldn't say plenty, but they have some cash on the balance sheet. They have some leeway here. They're probably going to move things, through. And, this company has grown really rapidly over the last couple months. Might be one to keep on a watch list and see what happens, but certainly do a lot of investigation before you invest in these types of things. Thanks for that question. That was a good one. Next question coming in here saying, hey there, thanks a lot for all the incredibly helpful videos. Thanks for the question and watching. I appreciate that. Would love to see your analysis on TTD, the Trade Desk. Thanks in advance. So the Trade Desk is actually a company. I actually have a lot of friends that utilize this. I'm pretty big in the, I wouldn't say I'm big in the ad space, but it is one of the ways I make money. I just do it for my own personal things, but I have friends that work at larger companies that actually use the Trade Desk quite a bit. And so it's a company I've been aware of. Man, it's been on a monster run. And so we'll take a look at the financials. I'll tell you what, things look really good. When we look at these financials, we'll just go over them from a high level. I looked at the balance sheet. There's almost nothing to see here. We got $200 million in debt, but we've got plenty of cash. This is a company that's doing really well from a balance sheet perspective. From the revenue side, things look good here. It's not as explosive growth because when you come over to the stock chart, the stock's been explosive. This has gone from $429 at the end of October almost, all the way up to $900. So this stock has basically doubled just in the last couple of months. Now, they reported earnings back in November, came in really solid. Okay, the top line probably not as quickly a grower as you might expect when you look at a stock chart like that. In the most recent quarter, we went from 164 up to 216. For the 9 months, 445 up to 516. Again, not really like this crazy growth. But what I think investors might have saw was this income from operation was really solid. It looks like they really have reached scale in terms of their expenses, and because we went from about 22 million all the way up to 42. I mean, we basically doubled our income from operations when we didn't. I mean, that would have been 320 on a double, and we were at 216. So yeah, they doubled their income from operations without doubling that top line. So I think investors saw that they really kept these sales and marketing and the technology and all this. These are pretty well in line with what they were before in relation to what kind of growth we're seeing here. Now, that all flowed down to the bottom. This net income number went from 19, basically doubled it, more than doubled it, up to 41. We see for the 6 months, or for the 9 months, it didn't hold true for up here, but on the net income side, we went from 57 to 90. So just solid growth. But I will include a link to this article. This guy, I'll give him credit here. This guy, Trevor Genuine, the really good article. Okay, this was published back in October. I'll put a link to this. Sometimes these things are behind paywalls. I do pay for this site, and so I'm able to see this. I wanted to show you this stat here. And so you've got DoubleClick, which is by Google, which is a demand side platform like similar to Trade Desk, and you have Amazon advertising as well. And what I wanted to show you here, obviously the Trade Desk has really grown. We've got Q1 18, went from 18%, looks like percentage of advertisers, all the way to 43. We see DoubleClick's kind of hovered into that, mid to high 30s. Now they're in the 40s, and we see Amazon's kind of in that 40s. So what I worry about a little bit here with the Trade Desk is, have we pulled forward a bunch of earnings? Have we pulled forward a lot of performance in the stock? Because how much can we go from Q1 2020 to Q1 2021, or whenever we analyze this a year later? Will it be as explosive as what we've seen over the last 2 years? I don't know, honestly. I'm not 100% sure. I know Google's going to capture a lot of business. Amazon's going to capture a lot of business. There's a lot of other smaller players in this space as well that are going to capture a little bit of business. So it has Trade Desk big growth days in the online advertising market? Is it behind them? Now, online advertising is growing, and part of this article talks a lot about that, how basically the total addressable market in online advertising obviously is trending upward, and as long as Trade Desk continues to capture a large percentage of it, their revenue should continue to go up. And so those are just things to think about. I'm not here to make a call one way or another on this one. I will say that this stock was on a nice little rocket ship, took a quick break, and resumed trend. We're kind of flattening out a little bit here, but it's nothing like we saw maybe here. I repeat myself here on the Q&A. If you watched another one of the questions, I don't buy stocks that really have made this monster move, at least in a significant way. I wouldn't, and this is a $900 stock, so if you're buying a full share, might be kind of tough unless you've got a large account, $15, $20, $30, $40,000 or more. $900 chews up a lot of your kind of weighting inside that portfolio. So one you got to be a little bit careful with. It's had a monster run. I prefer to wait for some kind of pullback. There is an area here, like there's some choppiness right in this box here. This would be an interesting spot if we have a nice little gap here. So actually anywhere inside this box, in my opinion, so that's 670 up to 750. I know that's like $200 off where the stock is right now, but that's where I would look for it. Okay. Any kind of pullback, that's where I would be getting excited, anywhere into this, in this range. Will it get there? I don't know. If I could predict that, I probably would be on a yacht somewhere right now. But what I would say is this does have me, I wouldn't say concerned. They've obviously grown into this valuation to a certain extent, but how much growth is left? So that's what I would be wondering with the Trade Desk. Certainly, they could continue to gobble up market share. These other companies are subject to a lot of antitrust things as well, which might slow them down a little bit, might open the door for Trade Desk a little bit as well. from a chart perspective, again, I like to wait for some kind of pullback. It's possible we see that at some point with this name. So hopefully I helped answer that question for you. Thanks for throwing that out for me. Next one's coming in from CR. Says, thank you for taking the time to answer so many questions on your channel. I have one regarding a real estate. Do you think it is a good time to buy a house in California, or would you be advisable to wait for a dip? Okay, so I live in California. I live in Northern California. I don't live in the expensive parts. I live in what's called the Central Valley here in California. So I'm kind of smack dab right in the middle of the state. I actually just bought a house with a group of people. We actually bought it in Arnold, California, which is considered kind of like the forest or the woods. I think Big Trees National Forest is just around the bend there in Arnold. So it's kind of a vacation home, kind of a future. What I'll probably do with it eventually is I'll cash flow it. I'll eventually do some kind of Airbnb or something with it, but that's probably several years down the road. It needs a little bit of work, but I'm going to enjoy it with my family and the group of people that I bought it with. But here's the thing about California. And we're talking specifically about California here. If you're from any other state, to be honest with you, you can completely ignore this because California is kind of its own animal, so to speak. So California real estate is really divided up. It depends on what area of California you're going in. If you're looking at the San Francisco market, I have a lot of family and friends that are in San Francisco real estate, that whole area. When I say San Francisco, I mean broadly the Bay Area. Man, that market, to me, it looks like it's ready to pop, and we've already seen rents decrease there. We've seen a lot of action in the Bay Area market because the tech companies are fleeing. Oracle just moved. Elon Musk just moved. Pinterest, I think, decided not to open a big office there. A lot of things are happening in the Bay Area, which I think should help see a dip, not necessarily right now, but in the foreseeable future. I definitely see San Francisco real estate taking a dip. Now, the thing is those people are moving. Some of them are moving to Texas, sure, moving to Nevada and other parts of the United States, but a lot of them are actually moving to other parts of California. When I was doing a lot of research on the vacation home I bought, I bid on 4, 5, 6, 7 different houses, and a lot of times I was bidding against people that worked at Facebook, worked at Google, worked at some of these big companies, and because now they can work remotely, they were looking to get completely out of the Bay Area. And so other parts of California are extraordinarily hot. And when things are hot, I don't think I would necessarily want to step in there and buy. I have a few close family friends that are a family and are actually looking for a single family home to live in, and they are having a heck of a time trying to find any house. There is just simply no supply of affordable houses, but even just in general, there's not a lot of supply here in California from a real estate perspective outside of the major cities like San Francisco and probably a little bit of LA, but that market is a little bit different than what is going on here up in Northern California. But other parts of California, especially the more rural parts, the cities that nobody really knows, those markets are actually really, really hot right now, okay? It is definitely a seller's market right now in real estate, probably across the country, but particularly here in California, outside of little pockets where you're seeing big disruption based on the virus and people just kind of fleeing the larger cities. And likely a lot of regulation, a lot of stuff happens in San Francisco that, quite frankly, if you live out here in California, kind of makes you scratch your head. So it really just depends. If you're an investor and you've got plenty of time, I personally would just continue to look for great deals. Now, the only reason why I closed on a house in Arnold in California is because I got a sensational deal. It was literally a 3-story house. Yes, it needs some work, but it's nothing major. I mean, it's turnkey. You could go live in it right now if you wanted to. It's 3 stories. It's on a cul-de-sac. It's on a private road. It has a great view. There's nobody around you. and I got it way, way, way under what I was bidding on some other houses. So I got a great deal. So what I would do, if you have money, you have credit or whatever, you have access to the money, what I would do is figure out what market you want to buy in California. Find a great real estate agent, okay? If it's in your town, look for the best real estate agent you can possibly find. If like me, I was trying to buy about 2-3 hours away. I had to go there and find a great real estate agent, and thank God I found her because she was the one finding me all these great deals. Now, so there's a lot of legwork. Again, I had to drive back and forth. I did a lot of work to find a great deal, okay? But they are out there, okay? So you just have to be very, very patient. And it also is market to market out here in California. I wouldn't say broadly the California market is one way or another right now, like we're all headed for a dip or the entire market is going to go up. I think it's going to be area by area out here in California. And if you have some access to capital or you have the cash, the deals are out there, but you really, really need to look for them. And I'm not just talking about getting on Zillow and things like that. You need to get a really good real estate agent or really know the area yourself, because the deal I got access to it before it was on Zillow and the MLS. I got access to it before, got in there and looked at it, was able to make an offer, and I actually got it. It's crazy. Things out here in California are going for, there would be houses where I bought one that were listing at about 300,000 and they would sell for 420. Okay. Like crazy. Like things were going for 100,000. I actually got my house. I think it was listed at 300 and I got it for 290. I actually got it for under list, which is almost, my real estate agent was like, that's unheard of the last a year or so in that area. So find a great agent, find somebody that you're comfortable working with, get some good financing. Just be patient out here in California. I think a lot of things are changing out here, and I would just, be aware of that and pick your spots depending on where you want to go. Also have a very, very definitive plan what you want to do with the property, whether it's flip it, renovate it, Airbnb it, whatever you want to do. Have a plan in place so you can execute on that plan if you do get a good deal. So hopefully that gives you a little insight on the California real estate market. Next question's coming in from Joe saying, love the Q&A videos. Would you please do a review on Avaya Holdings? I think it's how it's pronounced, AVYA. It's a digital communication company migrating to the cloud and trading at a forward PE of 4.22. That's incredibly low. They do have some debt, but I can't for the life of me figure out why the valuation is so cheap. So let's take a look at this one. So they just reported earnings. They've had a great year in terms of stock performance. This stock's up about 43% this year. They reported earnings not too long ago, and what they did do is give full fiscal year 2020. Now, on their earnings, that it just ended their full fiscal year. So we have 12 months here, and this is kind of their fourth quarter here in the quarterly view. What I did notice, a couple things that I noticed that might be impacting the valuation. I don't know from an earnings perspective. I see on a trailing basis, this company actually lost money. They lost money in 19, $670 million. They lost $680 million in the most recent year. A lot of that has to do with they have these impairment charges. So they had 660 in the previous year, and it looks like those rolled forward into this year as well at about 624 million. So that really impacted their profitability. Now, for the fiscal year, they're previewing 2.875 billion to 2.9 billion in this is revenue, and we see here it was in full year 2020. So this is a company that is previewing basically what I would call a flat year. Now, they could be sandbagging. It could come in higher than that, and they're just kind of sandbagging shareholders. I don't know. I see from a quarter over quarter, year over year basis, this is a steady business. And so that could be one reason why the valuation is low, because in today's market, people are looking for that growth. You could be like a Nikola and just have really cool PowerPoints, and you can get this massive massive valuation. You can be a company like this that is really steadily churning out revenue, have pretty high gross profit margins, have operating income if you don't factor in that they had these impairment losses. So, these types of company kind of get overlooked, I would say, from that perspective, possibly. Now, a non-GAAP operating income about 558 to 600 million. This is for the full year. And so, yeah, you can kind of back that into the 1.6 billion valuation. This is not earnings. This is operating profit. They didn't really give you kind of net income here. So it's hard to kind of really, really look forward because they didn't really give us like net income. They give us GAAP operating income. They give us non-GAAP operating income. But if you follow the channel to any regularity, operating income can be net income, but it can vary widely. We see here it was 74 operating income, but we actually netted out 37. And it's to my belief that a lot of price to earnings is factored into this net income. So that could be another reason, is just after you factor in taxes and all this other stuff, this company's just aren't bringing a lot to the bottom line. They're not growing this top line very rapidly. They don't pay a dividend. They're not necessarily executing on a massive buyback. Like you said, on their balance sheet, there is, I wouldn't say like significant amount of debt, but there is a fair amount of debt here. We've got long-term debt here. That is $2.8 billion. And you see here in terms of cash, they have about, if you throw in accounts receivable, they've got about $1 billion. So not, from a balance sheet perspective, not the most impressive company. You've got total assets here at 6.2. A lot of it, over half of it, is intangible assets and goodwill. Only about 1.5 of it is actually current assets. And when you come down here and take a look at total liabilities, you're at 5.8, and 2.8 of it is likely some bank debt. So a fair amount of debt compared to assets, in my opinion. That's also likely keeping the valuation somewhat low on this one. But look at the stock chart. The stock chart's actually been performing really well. This thing pulls back and kind of pivots really quickly. So, look, from a stock perspective, this one looks pretty darn good. It's been on an uptrend. Would I step in here and buy it? Probably not necessarily. But any kind of deep pullback, that's personally what I would wait for on this one. This one has pulled back. It has pulled back sideways, pulled back. We're kind of in a sideways pattern here. This wouldn't be, technically, this is an area where some buyers should step in this box that we have up here. So, I honestly would be watching to see what happens here inside this box. Do we, notice that it has acted, now that we're right here, this has acted as resistance, and this could be what some people refer to as kind of like a blow off top. We kind of come up here and then we have trouble getting through this. Buyers end up disintegrating, and then we break down. Then you'd come back down to levels, I would guess like right in here would probably be an interesting level. So that's about $16 per share, about $3 lower, give or take a couple pennies here, where, inside this box, in my opinion, would be an exciting spot. So look, they've guided a very steady fiscal 2021, the GAAP operating income in line with what you'd expect, low valuation. The stock has done really well over the last year. I'd be patient on this one. I don't think you need to run out and get into this one, because they've guided for the full year. Everything looks pretty steady. This moving average is starting to flatten out. We're at a level here where this thing either is going to get rejected or it will retest these highs. Look, that's kind of where it's at right now. It could channel sideways up in this upper range, but what I normally see up in this range is eventually either buyers take over and push you back up into the $20 range, or buyers dry up and sellers step in, and this thing could sell off. So that's what I would be looking for in this one, just in the shorter term in terms of chart action. Longer term, they're guiding very steady. This is just a steady stock, but just understand, it is not on Seeking Alpha, only 3,000 followers. That's like almost nothing. Okay, so this is a very, very, undercovered stock, undiscovered stock. So if you know the market, you do a lot of research, you think it could be something that gets discovered. Again, they had great performance this year in terms of stock price. So it is a stock that has done well over the last year. Just depends on where you want to be with your allocation and types of stocks that you want to own. Doesn't look too bad from a financial perspective, but again, I don't think it's like lighting a bunch of investors' excitement level, and so that's why the valuation might be a little lower than what we've seen across other markets. So hopefully that one helps you out. Next question coming in here. Thank you for the Q&A videos. Hey, thanks you guys. You guys are the ones that are making this one happen for sure. Any recommendation for a video tutorial or books on how to read charts? So what I would say, it really depends on how nitty gritty you want to get in the charts. I personally have never read a book on charts. I know that if you go to Amazon or bookstores or anything like that, there's going to be some major books on this topic that are going to talk about all, we're on a 30-minute chart. They're going to talk about all these little formations and what they mean. If you want to get into that, by all means, I would definitely get into it. There's actually programs out there if you really want to get not only learn how to read charts, but then get like recognition that you can actually read charts, like something maybe you can use if you want to go work for a bank or if you want to get on YouTube and just have a little bit more credibility. There's a couple different ones. I think the most well-known is a Chartered Market Technician, a CMT. I think you can actually put it after your name, almost like PhD or like, some people that are like RN, like a nurse or something. So you go through these. Now it costs money. You have to study. You have to take tests. You have to actually pass this stuff. I think you might even need some work experience. So it's not an easy thing to do. But my guess too is you can probably find this curriculum. You can probably find it either online or at a bookstore, or purchase it and not necessarily have to go through the program, but you can learn what all these chartered market technicians are doing. So that's another way to learn. Okay. For me, if you like reading, what I would do personally, this is more broadly, figure out how you learn the best. Like, do you learn the best by reading? Do you learn the best by watching a video? Do you learn best by like having it read to you, like Audible? So those are the things you want to think about. If you have trouble digesting a book, I wouldn't necessarily go that route. If you learn better by videos, I would go that route personally. Now, there's two YouTube channels that this one actually I recommend a lot. In fact, I've been on his show twice this year. It's the Trader Merlin show. Well, in my opinion, just a fantastic show each week. Will he give you the golden goose each week? No, not necessarily, but he brings on lots of guests. I mean, this guy is religiously posting here and, every day. The videos are long, okay, kind of like this Q&A video. Maybe listen to it on 1.5 speed so you can move through them a little bit. But what I've found is a lot of guests that appear on his show, I learn a lot from them. I learn a lot from Merlin himself, but I also learn a lot from his guests. And one of the guests that he's had on recently was the Don Francho here on YouTube. I like this guy, okay? He trades, he's very much a trader, okay? He talks about long portfolio and things like that, but he doesn't get into the weeds on fundamental stuff like we do here on our channel. If you want more technical analysis, and I also like he has this how to draw zones for trading. Okay, this is a good video. He basically goes through his technique on every video, but he also has these videos where he's really getting into it. I prefer the Don Francho Trader Merlin style of technical analysis. That I don't want to say like I do it here on the channel, but I've learned from these people where we're looking for levels. Okay, we're not necessarily looking at this candle and saying, oh, it's a spinning top or it's, a spinning doji or whatever. There's certainly, value in that, especially if you're day trading. But what I like about the Don Francho, what I like about Trader Merlin is we're picking zones. Okay, we're finding areas of supply and demand, and making trades or making decisions to buy or sell or start a trade, end a trade based on price action and price action alone. And it tends to be really easy to understand. Most of these guys don't even use MACD or RSI or any other indicator out there, and often not even a moving average. So they're very clean type of way, in my opinion, to really understand how to do some technical analysis, at least from, or chart analysis from, an entry level. I think you can really learn, and these guys are a much higher level. I don't want to make it seem like these guys are entry level, but in my opinion, they teach a style that is very easy to learn, very easy to understand. Once you watch them go through it enough times, you'll be able to start drawing these lines. And this one might not be that good, but this is pretty good. This is pretty solid up here. You see that we have a nice little channel here. When we bust out of the channel and we come back through, we usually retest down here, same type of thing. So it's something that we talk about on the show, but I would recommend starting with these two channels, going down a rabbit hole with the guests that they bring on, with the tutorial videos that they posted. If you have any questions, I'm sure both of them would be more than happy to help you out. If you're going the book route, search Amazon and things like that, but also look at this Chartered Market Technician kind of course. Maybe there's some coursework and things online. And if you want to go through the program, if it's something you really want to get dedicated to, look, I would actually try to get this, and then you could get a job, or at least could give yourself some real credibility, considering that you will have gone through an entire course. So hopefully that helps you out a little bit. Next question says, thanks for the PLTR analysis. I know a lot of people actually appreciated that one, so thank you. Curious about your thoughts on renewable energy stocks as President Joe Biden administration takes over. Will NEE be a good choice? Much appreciation as always. So here, just really broadly, so first of all, I brought up the stock chart of NEE. I got a 5-year chart of this. So this includes back into 2016, even 15, right when President Trump was elected. This stock was a $30 stock, and we see here today it's at 75. So the first thing I would say is, to me, it doesn't look like it matters who's the president, okay? Because this stock basically doubled under the previous president. And now that we have Joe Biden coming in, here's what I would say about politics and stocks. I would tend to avoid it a little bit because, yes, maybe Joe Biden does some things that is good for the green energy sector, but at the same time, what if he does things that are in generally bad for maybe corporate taxes or corporate governance or corporate regulation? Those types of things, in my opinion, could affect a stock more than just in general, like these energy stocks. Now, obviously, there's some herd mentality as well. Joe Biden comes in, people think they'll be better for renewable energies, so that could definitely drive the price forward. I don't personally like to invest like that, to where like, okay, everybody thinks Joe Biden's going to be good for this sector, so I'm going to go buy it. I just don't like buying stocks like that. I like buying stocks based on the fundamental data that we see here and a little bit of the chart action. I like to pick where I'm going to buy this stock. Once I decide, okay, financials look good, sector looks good, I'm going to pick some levels here where I want to buy this thing. Now, what I did notice, I brought up the revenues here. I don't like how they do them because you kind of, at least from a presentation on the YouTube, it doesn't work that well. But we have operating revenue here. It came in for the last 9 months here at September at a 13.6 billion. I want to scroll down to the previous 9 months. Unfortunately, I have to do this. This is in 9 months. So we got operating income was actually 14.6. So we actually had operating revenue actually decline over the last year. We've got our operating income here at 4.476, and we came in at 4.176 this latest 9 months. So revenue's down, operating income down. And so in my opinion, again, not something that I would say is a complete deal breaker on this one. But The other thing you need to keep in mind is this stock has gotten pretty expensive, at least compared to itself. Now, from the sector perspective, maybe not, but from a price to sales basis, it has basically never been higher. It's trading 8 times sales, and over the last 3 years, this stock has always traded a little bit lower than that. So from a price to sales basis, maybe a little expensive. Again, part of it could be due to what you're saying is there might be a little bit of a herd mentality that the Joe Biden administration takes over, and it's a good choice. But what I showed you here was this stock was a good choice under President Trump. And so it could be, again, a good choice no matter what. And so, and also the other thing you need to keep in mind is Joe Biden's at the mercy of the Senate and the House of Representatives and who has control of that. And I think there's some votes coming up in the couple weeks that might kind of sway that one way or another. And so the other thing you need to keep in mind is Joe Biden's I would say only, he potentially could only be president for 4 years. And so if you're looking for a good choice over the next 4 years, maybe, but maybe he does think something in year 2 or year 3 that almost assures that he doesn't get reelected. You know, these things, I don't like to play the politic game when it comes to stocks. I tend to ignore it because in my opinion, stocks are going to do what they need to do. And they're going to go up if the sector and everything looks good behind it. Even if a president comes in and is either overly positive or overly negative on a sector, these things can still go up. I mean, Donald Trump was completely negative on the tech sector and the newspapers. And if you look at tech stocks and newspaper stocks, they've pretty much been ripping ever since he's been elected. So I would caution people on, really following that advice. Can it work in the short term? Of course it can. Is it a long-term viable thing? Like, are you going to do the same thing in 4 years, whether Joe Biden is reelected or a new president is elected in 4 years? And then every 4 years, are you going to keep being able to replicate that strategy? I don't think so. Personally, I don't think that strategy is replicable. That's why I tend to focus on the numbers and the stock chart as well. Now, I did pick out 2 levels here. There is a key level here, right at about $69 a share. It's about $5 under where we're at today. There was a lot of price action here. It was a top here, and we got rejected pretty hard. So this should act as some support. Any break of about the $70, $69, $70 level could bring us down into this box. In my opinion, this is where I would look to buy shares. If you want to, if you believe in the story, if you know a little bit more about, or you follow politics a little more closely than I do, or give a little bit more weight to it than I tend to do when it comes to investing, this is the box where I personally would be looking at, in my opinion. Any pullback, this is like a 50-day moving average, any pullback closer to that, in my opinion, where I would want to step in. But look, the stock has been a fantastic performer over the last 5 years. I really don't think it matters who the president is. It's looking like a good choice to me. Next question's coming in from Dimitri. He says, thank you for your videos. Thank you guys for watching them and commenting on them. I appreciate that. Just finished watching your Nike video. Do you have a stop or a trailing stop on such profitable position? Okay, so what he's talking about is last week or a week before Nike reported earnings. And in the video, I showed my Nike holdings, and I'm not doing this to brag. I certainly could Photoshop some zeros on here if I wanted to do that. And what I'm doing this is really hopefully to inspire or to motivate anybody watching to invest and save for the long term. What I showed was I started buying Nike in 2016. The price was at 63, and I kept buying it actually for about a year. Okay, I ended up making my last significant buy down here at about $55 per share. The rest of this is just dividend reinvest, actually $50 a share here in 12 of 16. So a year went by where I actually added to my shares. I started buying at 63 and stopped buying it at about 50. Now, the stock has just gone on a rocket. I think it's about $140 per share. So this gain over the last, call that about almost 5 years, is up about 147%, or about $2,200. So the total value of this position is $3,757. Now, it just happens that this is in my IRA account. This is a buy and hold. I rarely sell. I mean, I rarely sell out of this account. You can probably count on one hand the amount of times I've actually sold stock. Now, that doesn't count moving in and out of money market accounts or treasury accounts where occasionally I have cash in here. Like right now I have about $1,400 in cash. So occasionally I move that money. If I don't see any stocks to buy, the cash starts stacking up. I move it into like a shorter term kind of treasury or something that yields some money. And then when I need to sell, I sell and I buy the stocks. And so his question was, do I have a trailing stop on such profitable position? I will tell you, in this account, no. And is that a good idea? I will tell you, because of my age, okay, I'm going to be 39 years old in a couple weeks here, actually. So I am not looking for this money. Okay, first of all, $3,700. I got 2 kids. I got a mortgage. I got a car. I got a couple cars. I got bills to pay. $3,700 not going to make or break. If Nike stock goes to zero tomorrow, $3,700, it wouldn't even register to me. Okay, so that is one thing. Second thing, this is a retirement portfolio. I'm going to be 39 years old. Hopefully, if I have good health and all that stuff, knock on wood, I will be able to cash out of this or start cashing out of this, I would guess maybe about 20, 25 years from now. So that's really my holding time. Do I think Nike's going to be around in 20, 25 years? Yeah, probably. Honestly, I think so. And so that's really, now, will I manage this differently if I was 49 or 59? Absolutely. And so that's the emphasis I want to make on this question. And that's why I told you my age and my time horizon, is because that's how this question will get answered differently depending on who you ask and depending on their time horizon. And so personally, I am not worried if this entire portfolio goes to zero. It's not going to make that big of a difference to me. Certainly, I don't want to see that. But if it does, it's not that big of a deal. Now, if I was 49 or 59 years old, especially 59, I would be putting trailing stops under most of these positions, especially the more significant ones. If it was 3,000 and the account had $1 million in it, probably wouldn't worry about that. But if my account has $1 million and I have a position that's 60, 70, 80, $100,000, absolutely, I'm putting trailing stops under that because I might need that money. Okay, I'm 59, 60 years old. I might need that money. Okay, I might want to go take a vacation. I might want to pay for my kids' college loan or whatever. You know what I mean? So it really just depends. Just because I'm not on here putting trailing stops on this doesn't mean that's not a good idea. In fact, I think it's a great idea depending on if you need this money. Let's just say you're a young kid and you're kind of putting like your lunch money essentially in the stock market. And if you lost that money, you might not be able to pay rent next month. Well, of course, put some trailing stops under this. And then obviously, if you're older and you're going to rely on this money, I could potentially rely on this money to actually survive. Okay. Absolutely, I would be putting trailing stops. In fact, I might even take a little bit off the table at that point. You might get out of equities and into other investments. We're now talking a little bit more about portfolio allocation, but I think you get what I'm saying here. But no, in this account, I have many, many very, very profitable positions. There's my really bad ones. Whew, get those off the screen as fast as we can. But I do have some very profitable ones. Okay, I have several stocks that I'm up quite a bit of money. And no, I don't have any trailing stops. I don't have any stop losses under them just because of where I'm at in my life, in where I will potentially need this money is not right now. And so hopefully that helped answer your question. Next question coming in here. Of all the YouTube investing educators that I watch, I think this is the best. Thank you. I'll send you a check here right after the show. Very thorough and unbiased analysis. That's what I try to be. I think there's definitely more entertaining and probably well-spoken educators, but I try to be as thorough and as unbiased as possible. Quick question. If you were up 100% on NEO or BILI, would you sell your profits when it's reached its peak, then buy back at the same amount when it's at a lower price point, say 3 months from now? Or do you think it's best to hold? I'm not much of a swing trader, but maybe you gain more working that way. Okay, so this is a really good question. I actually get this question a fair amount here on the channel, not just the Q&A section, is, hey, I'm up this amount in this stock. What should I do? Here's what I would, first of all, it's a great problem to have. Okay, first of all, sit back, take a broad view of it and say, this is a great problem to have. I bought a stock and it's up huge. Actually, here's the first thing I would think about is, how did you do this? Okay. How did you stumble upon NEO? How did you stumble upon Billy or BILI? How did you find these stocks? What research did you do? Because here's what I would want to do. I would want to figure out a way to replicate this. Okay, you're not going to be a Babe Ruth or Wayne Gretzky and hitting home runs or scoring goals every single time you touch the puck or the ball. But if you could replicate this to even a small degree, if you're getting these types of gains, I would figure out how to replicate that. So that's the first thing I would think about. I would actually focus more on that than anything, is how you're going to replicate this time and time again. Okay, now back to your question a little bit. First thing I would do is, when you buy a stock like a NEO or any stock, doesn't matter, it's not necessarily NEO or any of them, is I would have some type of plan in place. And this is why I like having multiple accounts. Okay, I have an E-Trade account up here that I showed here in another segment of this Q&A. I've got a Robinhood account where I've got a couple $1,000s in. I've got a Schwab account that I've got a couple $1,000s in. I've got other accounts that I have some money in. And so each of those accounts are all for certain things. My E-Trade's my retirement. My Robinhood's kind of a hybrid. I trade in there. I like to buy the dips on Robinhood and buy just little shares here and there based on news, pops and drops, things like that. And I do a little bit of selling in there. And Bitcoin as well in there too. And my Schwab account's probably a mixture of a little bit more ETFs and more passive investing in there. So that's, now the reason why I'm saying this is that helps make your decision, right? Okay, so if you bought NEO in a retirement portfolio, now you're kind of in a portfolio that you don't churn, you don't sell. Then it's like, okay, I'm holding NEO. If you bought NEO in, say, your Robinhood or like a Webull account where you're kind of trading, you're just trying to build up money, well, now it's a pretty easy decision. You're going to sell a little bit, okay? And so that's what I would think about is why did you buy it in the first place? Obviously, you're buying a stock for it to go up. You know, you're shooting a basketball to make it. You're not shooting to miss, okay? Same thing with buying stocks, okay, right? But now what I would do is kind of plan it through before you buy. Okay, so when you bought NEO, and now obviously we're looking back now, but next time you do this, I would make that decision up front. Okay, I would make the decision when you buy the stock. Like, I'm trying to buy the stock here, and when it gets to here, I'm going to sell, or I'm going to buy the stock here, and I'm just going to hold it and turn on my blinders, and I don't care where the stock, how much it's up, I'm going to hold it, okay? Or you can start making decisions where when I'm up X amount of percentage, then I start taking a little bit off the table. That's another strategy that I know a lot of people do, is they're up 100%. Let's say you had 10 shares of NEO, you're up 100%. Well, maybe you take 20, set a rule that once you're up triple digits, you take 20% off the table. Or you take a share or two off the table, however you want to look at it. I would set up rules based on your situation, based on what you're comfortable with, and follow through on those when the stocks hit your target, okay? And if you just want to hold and just buy and hold and close your eyes, that is absolutely okay too. I would have a very separate portfolio for just buying and holding, never selling, never touching, okay? Typically maybe like a retirement portfolio. So hopefully I helped answer your question a little bit. Yes, swing trading is great. I also have a swing trading account inside this TradeStation account is a swing trade account in here. So I'm up $104 off only $1,000. So I'm up 10%. So now my buy and hold investments are up way more than this. I'm way up more than 10% this year, based even the last 6 months on a buy and hold. But swing trading is still fine, and it's still something that I think everybody should learn, especially if you want to get, if you're really excited about the stock market. So to sum things up, I hope I helped. I know I talked about a lot of different things here. So to try to sum things up, I would create a plan right from the beginning. Okay. And what I would do is a broad plan, not just for NEO, not just for the next stock you buy. Create broad sets of rules to where if you buy any stock and it goes up 100%, based on what portfolio you bought it in, that is going to trigger some rules. In a buy and hold portfolio, you're not going to worry about it. You're just going to keep watching it go up, hopefully. In a swing trading account, you're going to have very specific points where you're buying and executing a sell. Inside maybe a portfolio, like I have one, like my Robinhood account, where I've had some I've had some stocks in there for 4 or 5 years, but then I have some other stocks that I buy, and when they go up, I sell them, okay? Or I sell a portion of them. That's typically what I do. When I get to a certain level, it's typically driven by a stock chart. Once I get to a certain level, I'll take some chips off the table. And so I would set some rules up like that, like, when a stock is up 100%, take 10% off the table or 20%, whatever you feel comfortable with, whatever you want to do. And I would have this all in place before you make your next trade. But I want to congratulate you. You're up 100% on these stocks. Figure out how you would replicate that time and time again. And even if you swing and miss a few times or miss the goal or miss the basket, look, if you're picking winners on a large percentage of the time, you're going to have a very, very successful investing career. Hopefully that one helped you out a little bit. Last question coming in here. When you analyze a company, do you read the entire 10K? So this is a good question. So what I did is I brought up a 10K. This happens to be the trade desk, which is something we talked about here on the show. Now, this is 80 pages long. You could easily come through here and read this. Okay. There is a lot of like legalese and kind of stuff in here that you don't necessarily like, mine safety disclosures, things like that don't necessarily apply. I'll show you some of the spots where I do read risk factors. You don't have to read these word for word, right? Okay, this is all written, or I want to say all, but most of this is written by lawyers, okay? But there is sometimes some really good information in here, quite frankly. There's some interesting stuff. I do tend to read these. I'll tell you when I read a 10K very, very closely. It tends to be on the more speculative stocks or the stocks that don't have any revenue, okay? So maybe like a startup or something like that doesn't really have any revenue, no profits. I will dig through a lot of the 10K. I don't do it as much as I used to 4, 5, 6, 7, 8 years ago, because quite frankly, I really just invest in kind of mega cap companies these days. And so in that situation, I'm typically just focusing on this selected financial data. So you come down here, you see the revenues, you see the profits, you see a lot of this, and things like this can teach you a lot, in my opinion, about the company. So when I pull up a 10K, I'm going to first jump down to the financial data. If the financial data, here's some shortcuts, okay? Figure out how to read this financial data. Figure out the metrics that you're looking for. Maybe you're trying to find really high net income companies with solid balance sheets, like a big moat around their business in terms of the financials. Well, then come check that box first before you come into the rest of this document. Maybe you're looking for explosive growth. You're looking at 40, 50% growth or whatever is good in a certain sector. Come down to revenue, check that box first. Or maybe you're looking for a company that has really high gross margins or net margins. Check that box first before you dip and dive into the rest of the document, okay? But I would definitely take a look at risk factors, especially new business models. If it's like a really seasoned business model, a lot of the risk factors have already been kind of played out. But I remember when like Uber still is like a really like fresh business model. But I remember like reading through their risk factors when they first came public, because there was no other public company like them. Okay. So reading through their risk factors, the smaller companies as well. The other thing you can come in here is look at executive compensation as well. If you want to come in here and see different types of things in here, this stuff occasionally can reveal some interesting things as well. But in general, no, I don't read these documents cover to cover, but there's definitely some interesting stuff. Finally, if it's a company you have no idea, like oftentimes for me, it's like medical device or healthcare companies, which I don't typically invest in. But back, 4, 5, 6 years ago when I was trying my best to invest in them, I would come to part one of the business. And they talk about exactly what they do. They talk about like when they started. They talk about their industry. They talk about everything. Okay, just keep in mind, this is like, this is almost like a Tinder profile or something, okay? You're not going to put on your Tinder profile that you got 8 ex-wives and 4 baby mamas and things like that, okay, right? You're going to, you're going to say you like walks on the beach and you work out every day and you do yoga and you're a great dad or something like that. You know what I mean? Like that's what you're going to put your best foot forward here in the business. But I will say with like medical devices, in an industry where you don't know anything about it, this will give you a really good overview. And so you can kind of understand, okay, this is what this company does. Because sometimes you think a company does one thing and then you actually read what they do and read how they make money. And it's a little bit different. So hopefully that helped you out. Okay. There's a lot in here that you don't necessarily need to read. I would start with the financial data. I would come back to risk factors. I would go to the business. If you have absolutely no clue about what the company does, I would go there and pick and choose where you want to come on this document. So hopefully that helped you out. I've got a ton of questions here. Okay, thank you all for submitting them. I saved these. I will be back again very soon. If you've asked a question, I will come back. I promise I will come back and I'll answer it on the next video. I just try to make these as palatable as possible because they get kind of long. They take a long time to edit. They take a long time to upload. So I'm trying to keep them to about an hour's length, but I will get to the rest of these. If you have a question, leave me it in the comments below. I'll get to it as quickly as I can. Thanks for tuning in today, guys. Good luck with your investments.